A question I get asked fairly often is, what the heck are bonds, right? A lot of us have stocks and bonds in our portfolio. Many of us are familiar with what stocks are, but what the heck are bonds and what do they represent? So today's video is going to talk about this. So really, bonds are how corporations raise debt, right? You and I, when we want to buy a house, we get a mortgage. We go to the bank, they give us a mortgage, and now we have an obligation to pay back that bank every month for, unfortunately, 360 months, usually, sometimes 180 months. And it's the same thing for corporations. Now, when a company is first growing, they're probably going to their local banking and asking for a loan. But as they get larger and more established and they have a healthier business, sometimes they can access the public markets. And instead of going to the bank, they can issue bonds at a lower interest rate than what they could get from a bank, which is why they do it. So just like a stock is on a public exchange, like the New York Stock Exchange, bonds are also listed on a public exchange. And companies can issue that in a different process, but somewhat similar to how they go public. So they announce that they're going to do a debt offering. They work with an investment banker. The investment banker packages it up, usually in pieces of $100,000 is the initial tranche. And let's say a company like Walmart needs to raise money. They might issue bonds for 5 years, right? And how secure is a bond like that, right? It's basically Walmart, in this case, is like you and I, when we have our mortgage, where we promise to pay the bank back so much money a month. In this case, Walmart promises to pay back their bondholders so much every year. Typically twice a year is what the payments are for. And so the investment banker, does their magic behind the scenes. So these are tools that can trade electronically over an exchange. And what Walmart and what the investment banker wants is they want as many people as possible to participate in being able to buy these bonds, so that there's a lot of demand for it. The more demand that there are for bonds, the better. I should probably comment, I'm at a ski resort here today. Sorry for the quick aside. But the more the demand there are for bonds, probably the lower, in this case, Walmart's going to have to pay for that bond. Now, sometimes people say, well, I don't want, I need my money in a year, so I need to get paid back my money in a year. Well, even though Walmart might have issued a 3-year bond or a 5-year bond, you know what? In 2 years, now that bond only has 1 year left. And because it's publicly available, right, people can trade it just like they can trade a stock. Because of that, you can buy a 1-year Walmart bond, even though they may never have issued a 1-year bond, right? I mean, you could buy a bond that has 7 months until it's going to mature. Walmart likely did not issue a 7-month bond. So in this case, it is a debt and it's a promise. And usually with bonds, there are what's called floating rate bonds that'll pay you a different interest rate based on some benchmark. But in general, most of the bonds that most people buy pay a fixed rate. So what are the risks that you should know about with bonds, right? Just because it's Walmart, and is Walmart going to be in business 100 years from now? I don't know. Are they going to be in business in my example with that 5-year bond? Are they going to be in business in 5 years? I think it's highly, highly likely. So one of the important risks with a bond is creditor risk, credit issuer risk, like if Walmart were to have some financial problems. And then the other major risk, there's all kinds of risks, but the other major risk is what's called duration risk. So I talked about creditor risk. In this case, Walmart is a very strong company. So the likelihood, particularly, you buy a bond that's going to mature in 7 months, is Walmart going to be able to pay that off? The odds are highly, highly, highly likely. I guess something crazy could happen. But lacking that, it's highly likely you're going to get paid back. So what's duration risk? Duration risk is just a fancy way of saying, how long do I have to wait until this bond gets paid off? So, the duration of a flight from San Francisco to San Diego, I don't know, is probably about an hour. and the duration of a flight from San Francisco to New York City is probably 3 hours. So used in the context of a bond is, when do I get it paid back? Duration. So hopefully that doesn't sound like a big term anymore. It's really not. But the other risk that we're seeing play out over the last really year and a half with bonds is the duration risk, right? As I record this, recently interest rates were fairly low, and the Federal Open Markets Committee, Jerome Powell and his peers, have been raising interest rates to try to tame inflation. So how does duration risk play into this? Well, think about that 7-month Walmart bond, right? If interest rates rise dramatically in the next 7 months, you're not that worried about it, because you're going to get your money back in 7 months, and then you can reinvest it at the then higher rate. But let's say you bought a 10-year Walmart bond and it's locked in, it's a fixed income, it's a fixed interest rate. You are worried about that, right? Let's say Walmart was going to pay you 3%. I'm just making up numbers here. Walmart was going to pay you 3%, but now they're paying 5% when they issue new 10-year bonds. Well, that's going to have an impact, and a very simplistic way to look at it is take the difference in the interest rate and multiply it by the number of years outstanding. Now, you get back it's a very simplistic approach. It would probably be, for a 20-year bond, closer to 15 to 17 years is what it would feel like. So in my case, let's say Walmart issued the 3% bond that you bought, and now people are getting paid 5%. So you're getting paid 2 percentage points less. And 2 percentage points over 10 years, simple math, is 20%. So that bond could be down, 15 to 20%. So yes, you're going to get your money back, but while you're waiting, you get less interest than what people currently could get. I hope that makes sense. So the risk when you tie your money up in longer duration is you could be stuck with a lower interest rate. And the opposite happens too, right? Interest rates peaked in the 1980s. And as interest rates came down on bonds, boy, the people that owned those bonds, that were guaranteed this higher interest rate for a long period of time, boy, they were really happy campers. They could either hold out in a relatively lower risk bond and receive that higher payment, or they could just sell it on the open market and get that higher rate. So I hope this has been helpful regarding what bonds are. It's not uncommon as we get older, as we get closer to retirement, that bonds become a significant portion of what your portfolio is. So I think it's important we all know what bonds are, and hopefully this has helped. I do need to say I'm not an accountant. And I'm not giving you financial advice here, just trying to provide some education and some information. I suggest if you have deeper questions, you want to learn more about bonds, reach out to an accountant or reach out to a fee-only financial advisor. You can find one near you just by Googling fee-only financial advisor. So do me a favor, if you found this video helpful, give me a like. It really does help the algorithm find other people that could benefit from this kind of information. Leave a comment. I do read the comments. They mean a lot to me, so thanks for taking the time to comment. And until next time, I'm Asul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use this time wisely.